Peter Lynch's core message in this chapter is that there is no single perfect moment to buy or sell stocks, despite how much time investors spend worrying about timing. The right time to buy a stock is when you have done your homework, understand the business, and believe you are paying a reasonable price for what the company can earn in the future. That said, Lynch does point out that there are certain periods when good buying opportunities tend to appear more often than usual. One such period is toward the end of the calendar year, when investors engage in tax loss selling. During the autumn months, individuals and institutions often sell losing positions to offset capital gains or to clean up their portfolios before year-end reporting. This selling pressure can push prices down well below what the underlying business is worth. Low-priced stocks are especially vulnerable during this time, since margin rules and institutional constraints often force additional selling. Lynch suggests that investors who keep a watch list of solid companies they would like to own can often find bargains during these months, simply because others are selling for reasons unrelated to business performance. Another fertile time for buying is during broad market crashes or severe corrections. Lynch points to the stock market crash of 1987 as a powerful example. During that collapse, many financially strong and profitable companies were sold off indiscriminately, even though their long-term prospects had not changed. Professional investors were often frozen by fear, regulations, or career risk, while individual investors who stayed calm and focused on fundamentals could buy excellent businesses at deeply discounted prices. Lynch emphasizes that true market panics, while emotionally difficult, are among the best times to invest for those who are prepared. When it comes to selling, Lynch is especially cautious. He admits openly that he has sold many great stocks too early, often because of outside noise rather than changes in the business itself. He describes how investors are frequently influenced by commentators, analysts, or market rumors, all of whom are eager to tell you when to buy and just as eager to tell you when to sell. This constant stream of opinions can lead investors to abandon winning stocks prematurely. Lynch's advice is simple: return to the original reason you bought the stock and ask whether that story has changed. For slow-growing companies, which are typically owned for their dividends, selling makes sense if the dividend becomes unsafe or if the company's financial health deteriorates. Warning signs include declining market share, excessive debt, repeated acquisitions unrelated to the core business, or a dividend payout so high that even a modest downturn could force a cut. If the income stream is no longer dependable, the main reason for owning the stock has disappeared. Stalwart companies, which are large, established businesses, tend to provide steady but unspectacular returns. Lynch suggests selling these stocks when the price